In this stock analysis video, I will share with you my simple investing process which has helped me get a consistent return of over 20%. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. This is down by 36%. Now let's look at the free cash flow, which is the money a business can generate from its operations. And this is up by 57%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. And this is down by 4%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. And this is down by 4%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital and return on equity are currently at 3% and 4%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. Using the current free cash flow, it would take 8.5 years to pay off the debt. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. The gross margin is a healthy 71%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Their operating profit margin is 8%, and ideally we would like this to be about 14 or 15%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. Their free cash flow is a decent 2.62%. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. And the average is just 3%. Ben Miller believes earnings growth is the biggest indicator to a company's stock price, and this has been 49% over the last 5 years. I've included a link if you want to check out the investors page and see the annual report. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 5 super investors who own this company. If we look back at AKO Capital's previous sales and purchases, we can see they have both bought and sold shares in Estee Lauder in the last few years, and has increased their stake in Q1 of 2024. They have $326 million invested in Estee Lauder, and this makes up 4.91% of their overall portfolio. However, 4 other super investors have sold shares. Ray Dalio has previously bought Estee Lauder shares, but over the last year he has been selling. He has $22.1 million invested in Estee Lauder, and this makes up 0.11% of his overall portfolio. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. We can see from 2014 until 2021, Estee Lauder's share price was making year-on-year improvements and rose greatly during the pandemic. But in 2022, as the whole market dropped, Estee Lauder fell with it, but has continued to fall due to some missteps which we'll cover later on. On average, the analysts believe that the price target should be $164, but some believe it can go as high as $225. Analyst reports suggest that Estee Lauder is probably still undervalued at the moment, and the overall consensus is that Estee Lauder is a buy. Collectively, the analysts believe after this year, the company will continue to grow between 13% and 88% over the next few years. So I will use the current earnings per share of 1.77 as my starting point when creating a valuation. Based on a combination of past growth and future analyst predictions, I'm going to estimate the earnings per share growth to be about 20%. I'm going to give Estee Lauder a PE of 50, and after that I'm going to project these numbers forward by 10 years. We then need to include a 15% return, and this gives me an estimated future stock price of about $548 per share for its future share price. And then we work out the current value that Fieldtown calls the sticker price, which is about $135. Then we apply a margin of safety, and at 25%, this will give me a buy price of about $102. If you found this video useful, click on the link to check out my last stock analysis. The return we would receive if we bought at our margin of safety price of $102 and sold at the estimated future stock price of $548 in 10 years' time would be 437%. The current annual dividend is $2.64 and the payout ratio is 148% at present, and is a bit of a red flag at the moment, as ideally we wouldn't want this to be any higher than 50% because a high payout ratio becomes unsustainable for the business. Lastly, the dividend growth is $2.33. Due to Estee Lauder having great brand value and product demand, the company is deemed to have a wide moat. The company has a strong global presence and continues to innovate its product lines. There's potential growth in emerging markets and the expansion of the digital sales channels. However, due to the shutdowns in China the other year, which lasted about 2 months, their sales forecast was cut in half and has since resulted in a lower demand in sales due to their lack of online presence globally, which is now why they are trying to make links with Amazon. In addition, their operating profit margin has halved since 2022, and since the pandemic their debt has tripled in 2023. But they are now in the process of reducing this. If you've enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now we'll summarise what we found out about the company. When reviewing the key pillars, Estee Lauder has scored 4 out of 12. Under ownership, 5 super investors have bought in the last few quarters and 4 have sold shares. Estee Lauder's share price is currently in a downward trend, and analysts are indicating Estee Lauder is a buy, and they are predicting they will grow between 20 and 40% over the next 5 years. However, this comes with a word of warning because over the last 5 years their average revenue growth has just been 3%. Whilst their average earnings growth for the last 5 years was 49%, this was mainly because it went up by 320% during the pandemic. Using the different valuation models, my personal buy price will be $102 or less, and for full disclosure, I own shares in Estee Lauder. If you want to find out more about my portfolio, click on the link above. It is considered that Estee Lauder has a wide moat, and my final overall rating is 3 stars out of 6, and I have given this a category C rating within my own stock watch list. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comment section to help me develop the content I am creating. And don't forget to like and subscribe.